Hello and welcome to ETF.com's webinar on ETF Trading, Tactical Solutions for Any Market. I'm Rebecca Hampson, European Editor at ETF.com, and I'm joined today by Matt Hougan, President of ETF.com, and Hector McNeil, Co-CEO of Boost ETP. Today's webinar will be split into three parts, and we will cover the basics of ETF trading, how to understand liquidity, and advanced trading strategies. Now, before I start, I'd like to remind you that you can ask questions anytime during the webinar via the on-screen boxes on the right-hand side of your screen, and we will pass them on later on. But without further ado, let's delve into the basics of ETF trading. Now, while you may be familiar with buying an ETF, trading it is a whole other story. But this trading ability of an ETF is what makes it so special. It has the ability to trade throughout the day, and this is one of the biggest benefits ETFs have over other products. It essentially means two things. You can get the position you want in the market, and in the case of falling markets, you can get out. However, knowing how an ETF trades, what liquidity means, when to trade, what the costs are, and exactly how to trade are all important things to understand, and I will cover them off as we go along. So firstly, how does an ETF trade? ETFs trade like a stock. They are listed on the stock market and trade like shares of stocks. Investors can buy as little as one share or as many shares as they like. But they're not stocks, I hear you say. True. And there are several features that differentiate themselves from them. For one thing, ETFs are still funds. And while they aren't exactly mutual funds, this is a good place to start when understanding ETFs. The big difference between ETFs and other passive products is that they can be traded intraday. A mutual fund, for example, will see orders placed throughout the day, but they will only be executed at the end of the day at 4 p.m. when the trading day ends. And while this is not the same as an ETF, understanding how this mutual fund works is a good way to get a handle on how an ETF starts trading. So trading an ETF involves buying and selling shares. But how can you buy the first share? Well, this is through an authorized participant. Let me explain. As with mutual funds, the best way to understand how an ETF works is to understand how the very first shares of an ETF are created. A mutual fund usually starts when you all come together, pooling your money, creating a mutual fund. Mutual because you're all invested. And you'll then normally hire a fund manager who takes your money into the market and buys up stocks. The difference and problem with launching an ETF is that you can only buy shares in the ETF from another investor. But how can you buy the first shares when they don't exist yet? It's a classic chicken and egg problem. Now the answer is that there's a group of institutional investors called authorized participants, or APs as you might hear it referred, who are authorized to create shares of an ETF. And before an ETF launches, one of these authorized participants will enter into an agreement to create a basket of ETF shares. And typically this might be 100,000 shares priced at, let's say, $25 each. But rather than sending the ETF company $2.5 million in cash and requiring it to buy the securities, the authorized participants will go out into the market and buy up all the individual securities that an ETF wants to hold. If this is, for example, an S&P 500 ETF, it will buy up all the individual stocks in the S&P 500 and then ship those to the ETF company in exchange for shares. These purchases will be made in exactly the right percentages to track the index. So if a certain stock has a weighting worth 1%, then the authorized participant will buy $25,000 of that stock. And once everything is bought up in all the right proportions, it's then submitted to the ETF company. In this case, for argument's sake, let's use iShares. And in exchange, the ETF company creates an equal value of ETF shares and gives them to the AP, the authorized participant, on a one-to-one trade. The trade works really nicely, as the ETF provider gets the stock it needs to track the index, and the authorized participants gets the ETF shares he needs to sell in the open market. And this exchange continues on an ongoing basis throughout the life of an ETF. And this trade also works the other way around when units are redeemed. It is this creation and redemption process that arguably makes ETFs as good as they are. So, now you know how an ETF starts trading. But there are other key factors to have in mind. The first one is understanding liquidity. So what is liquidity? Well, in a nutshell, it's how easily the ETF can be bought or sold without it affecting the price. And why does it matter? Well, the more liquid the ETF, the better the price, and vice versa. Now, you may have heard the term the bid-ask spread, and you might be thinking, what is that? Fear not. The bid-ask is just a fancy phrase that traders use, and it effectively means the difference in price between what the ETF was bought for and what it was sold for. And this is your liquidity monitor. Tighter spreads equal better trading, wider spreads, less efficient, more costly trading. And these are the most basic principles on ETF liquidity, but we will cover this further later on. So once you've understood liquidity and you understand how it trades, it's worth thinking about when the right time to trade is. Consider which time zone you're in. This is especially important if you're trying to trade an ETF from a market in a different time zone. For example, if you're a UK investor who wants to trade an ETF tracking an Asian market, then it's best to place the order as early in the UK day as possible to catch the liquid points in the Asian market, for example, not when it's closed. And the same is also true with UK investors going into the US market when later in the day is better. This will typically result in lower overall transaction costs for the investor, as the authorized participants will be able to quote tighter spreads when the underlying market is open for trading. And talking of costs, it's also worth considering transaction costs. Now, this is a tricky one, and that's because there isn't one fixed cost for trading an ETF. The cost of trading, or the commission, as it's also known, varies from platform to platform and also by region. For example, trading venues don't always charge transaction fees to retail investors directly, but instead they're charged to trading members, brokerages, and then these fees are passed on. Also, if you're a retail investor trading directly and multiple times throughout the day, this can mean the cost of trading rises quite considerably. In the UK, trading costs range from £5.50 per trade upwards. However, the most recognised cost is £12.50 per trade. So now you know how much it's going to cost and what the process is. So where do you trade? Where do you go? Well, there are largely three broad options investors can use when trading ETFs. They can either trade by themselves using a trading account, they can use a broker, or they can go to an authorized participant and trade through them. Let me take you through each one. Firstly, if you're trading on your own, you need to be armed with all the right information. And if you're feeling suitably informed on how trading works, you can go ahead. And this will include opening your own trading account online. But again, watch out for the costs on this and make sure you know what you're trading and how to trade. Secondly, you can go through a broker. And this is often advisable for those who are new to ETF trading, as a broker will trade your ETF for you. They can either enter the market directly, or in some cases, the broker can go directly to the authorized participant, or the liquidity provider, to place large orders. This is something that retail investors are unable to do directly. Generally, we find that brokers trade in two ways, live throughout the day, or at the end of the day, making only one trade. And finally, there's the option of going directly to the authorized participant to place an order. This is usually done with large order types and is most commonly done by institutional investors who can access the authorized participants directly. So this largely covers the basics of ETF trading, but I'm going to pass over to Matt Hougan, who will run you through some more advanced parts of ETF trading, including placing large ETF trades.
Thank you so much, Rebecca. I think that's a great overview. That's absolutely right. I want to talk about understanding underlying liquidity and a little bit about how to place large trades in ETFs that may not appear to have sufficient liquidity on the screen. And then I'll turn it over to Hector, who will give some more advanced strategies on the best way to get best price. So really what I want to talk about is the big mystery in ETFs, which, as I said, is how big trades happen in little ETFs, how you have ETFs that have seemingly no volume or assets, but which savvy investors can put 10 or 20 or 100 million pounds to work in an instant without seeming to impact the price at all. In other words, how you get the elephant through the knothole, and how you do it while getting the best possible price. So the tricky thing about talking about this is there are actually two big myths about ETF liquidity that I hear that trip people up. The first big lie is that you can only trade an ETF that's got huge on-screen liquidity. People use cutoffs of, say, 100,000 shares a day. If they're not 100,000 shares a day, they won't go near that ETF. And frankly, this is just it's a myth. It's not true. With careful trading, and usually with the help of a liquidity provider or an AP, large investors can place enormous trades in seemingly illiquid ETFs. It's a little bit like this volcano here. You only see the lava on the surface of the volcano, but there's a huge well of lava underneath. And not understanding that there's liquidity underneath ETFs is a huge problem for investors because they overlook huge swaths of the ETFs market. There are thousands of ETFs with less than, say, 100 million pounds in assets, and most people write off these ETFs entirely. Some even have rules that prevent them from buying these ETFs. And we'll talk today about how this unnecessarily removes a huge portion of the opportunity set from investors. But the other half of that myth, the sort of flip side, is this idea that an ETF is as liquid as its underlying. In other words, that you can trade without care any ETF, even if it doesn't trade on the screen at all. And you can get into trouble with this as well. It's important to understand the limits of that underlying liquidity. And just to give you a view of what we're talking about, this is a screen of a U.S.-listed ETF, but you could get a similar screen for an ETF listed in London as well. Or you're looking at an ETF that trades only a couple 100,000 shares a day on average, but we've highlighted here a trade for over 200,000 shares that occurred perfectly in line with the pricing. You can see the ETF was 53.15 bid and 53.17 on the ask, and that there had only been about 50,000 shares traded that day. But here, you know, an investor put in a savvy trade, executed 200,000 shares without affecting the price at all. Unfortunately, we also see trades like this. This is an actual trade in the exact same ETF, and you can see that this ETF was trading all day long at $50.80 a share, and an investor came along with a poorly executed trade, which went through at $55, or more than 10% over the normal price of that ETF. So what we want to talk about a little bit is how to be the first investor and how not to be the second investor. So to do that, again, I will do a brief reminder on how authorized participants work and what they're looking for and how they make markets in an ETF. And then we'll talk about where to set your trades to get that best execution. So let's imagine a world where you have an ETF that's trading at fair value. It holds securities that are worth $25 a share, and the ETF is in fact trading at $25 a share. But along comes a big investor who wants to buy, say, 1 million shares of that ETF. They may temporarily drive the price of that ETF up above fair value so that it's trading at $25.10, while its underlying securities are only worth $25. This is where the AP comes in and acts. They will sell 100,000 shares, let's say, of that inflated ETF and buy the underlying securities and therefore make an arbitrage profit, right? By doing that, they will drive the price of the ETF shares down and drive the price of the underlying securities up, and they'll be able to make, again, a risk-free or relatively risk-free profit of about 10 cents a share. And the reverse happens if the ETF becomes underpriced. If someone comes and, say, sells 1 million shares of that ETF on the open market, the ETF share price might drop to $24.90 a share, while the underlying securities are worth $25 a share, and the authorized participant will jump on this. They will sell the underlying securities and buy up shares in the ETF, thereby driving the ETF share price down slightly and the underlying security prices up. Everything snaps back into line at $24.99, and the AP has made a 10-cent profit. And it's this constant arbitraging between the fair value of the securities and the value of the ETF on the market that makes an ETF what an ETF is. But it's important to remember as you're trying to access this liquidity that the spread in an ETF incorporates more than just the spread in the underlying components. You might think from the example above that an ETF will always trade within the aggregated spread of what it holds, but there are other costs that an AP has to take into account as well. Their brokerage fees, their taxes, there's Forex hedging costs, their creation costs that they have to pay to the ETF issuer for the right to make these ETFs. And then, of course, they have to make a little bit of profit themselves. In an idealized world, you would expect an ETF to trade basically like this. This is a time shot of the iShares Russell 2000 ETF, a small cap ETF in the U.S. You can see that little dotted line at the top is the aggregated bids, aggregated asks of all the underlying securities in this ETF. And that dotted line at the bottom is the aggregated bids. And you can see that the ETF share price bounces back and forth between those aggregated bids and those aggregated asks. In an ideal world, an ETF should trade like that. I do think it's important to remember that size matters. The one sort of wrinkle in the idealized world that I presented is that ETF creations and redemptions typically only occur at large chunks, say 50,000 shares or 100,000 shares at a time. The most difficult sort of area to trade an ETF is if you're somewhere between 0 ETFs or 100 shares, which you can trade on a screen, and this 50,000 share creation unit. If you're trying to trade 10 or 20,000 shares of an ETF, it may not be worth an AP's time to make that trade happen at fair value, because if they create 50,000 shares to fill your 10,000 share order, they'll still have 40,000 shares on their books that they'll have to work out over time. So size does matter in an ETF. There is more liquidity than you see on the surface, but you have to be able to work with APs or put in intelligent limit orders in order to tap into that liquidity. And I think we'll, at this point, turn it over to Hector McNeil, the co-CEO for Boost, who has a huge amount of experience in executing ETF trades and helping ETF investors execute ETF trades, and can talk about the best way to make those sort of adjustments in the market. Hector?
Thank you, Matt. Very good overview, and I think a great background for people who maybe haven't experienced much in ETF trading, but may have experienced how to stock trade. And also thank you for Rebecca for a great intro. I'm going to try and bring it to sort of a practical application for Europe, because ultimately there are some differences between the US market and the European market. Essentially, the major difference is there is a split of business between the on-exchange traded volumes and the OTC market, which I'll explain first off. So essentially, the on-exchange basically means electronic trading through the order books of the exchange, which essentially is what we've talked about so far. But another important part of trading in Europe is the over-the-counter market, which is essentially the telephone market. Now, since the days I've been involved in ETFs in Europe, there's been definitely a migration of business from the OTC market onto the exchange, but there's still quite a delineation between the two. So investors essentially have a choice. They can trade on exchange or over the counter. And again, this sort of plays into the liquidity points that were made earlier regarding to the primary market through the creation of redemptions and the secondary market versus the exchange and that liquidity that can bring. You tend to find that the smaller orders tend to be on exchange and the larger orders will be OTC. And as an investor, you can understand that on the basis that if you've got a large order to do, you want to make sure you monitor that process and make sure the pricing is what you think it should be. And as I mentioned, the on-exchange volumes are increasing in Europe, particularly in markets such as the Borsa Italiana, Germany, but the London Stock Exchange to some extent is lagging behind, and the OTC market dominates still here, particularly because we have a peculiar quirk of the RSP business, which we'll talk about a little bit later. And we've talked about market makers and APs, but they do provide a very important oiling of the system here to make sure that essentially there's always availability of stock, and they do this really by entering into agreements with exchanges to provide markets all day long, and then they're either directly an authorized participant, a market maker, or they can go to an authorized participant to essentially create and redeem the units when they need them. And why a market maker can do this is because they can use a hedge in the underlying market. So essentially they'll be either long or short their hedge versus a long or short position of ETFs, and when that position gets large enough, they will create and redeem, and that provides the oil in the system to make sure liquidity, and this is one of the major differentiations between the ETF world and the mutual fund world, and by no accident the ET bit of the name, exchange traded, is the key component. We've seen in Europe quite a bit of competition rising between market makers, APs across the board. There's a significant number of them, most of them world-class players, and liquidity and pricing has improved dramatically. Early days when I was making markets in the FTSE 100, for example, on the LSE, early 2000s, the spread could get as high as 50 basis points. Now you'll find that the bid offer spread on exchange will be sub 10 basis points all day long, and in significant volumes. MiFID and best execution requirements has also made a big impact on the market. And to this point now you're seeing the growth of the RFQ facilities, so request for quote. So rather than doing an immediate trade on the order book, an institution or a larger shareholder will send an order to several APs and market makers at one time and ask for a quote, and then they'll pick the best quote based on what comes back to them. And the systems that you're using for this are Bloomberg, RFQ, Hub and TradeWeb, and this has been a development in the market over the last few years, and really is helping that best execution requirement. The UK retail space, actually, we mentioned retail service providers. It's in some ways a bit of a trailblazer because it's been around for a long time. And interestingly, most orders that are executed, whether common garden equities or ETFs, don't see their way directly to the London Stock Exchange. They go to third-party market makers such as Winterflood, Peel Hunt, Cantor Fitzgerald, who basically will provide identical liquidity to the London Stock Exchange and execute all those orders in the relevant retail trades. And then essentially they will go and hedge themselves directly on the LSE. So the LSE will see the aggregate orders, but they won't see the individual orders that the retail market comes along. And one of the other interesting developments we've seen recently is the development of retail platforms, such as Eccentric, Aviva, etc., which have been typically used for mutual funds only in recent times. But what we've seen very, very recently is the adoption in these platforms for ETFs. And there's quite a lot of change going on in that sector of the market to be able to facilitate the trading of ETFs and make it easier for the retail participant to be able to hold and trade ETFs through this medium. So what are the realities of ETP trading? Well, essentially, as people learn more and get more educated, they get better at something, and this is what we're seeing in ETP trading. And essentially, you're seeing that people are getting more and more used to trading products, getting to understand them. I remember when we started trading Japan and China for the first time over 10 years ago, and these products seemed incredibly complex at the time, but today they're seen as very common garden products that are very easy to trade. But what we're seeing now is that certainly many investors are comfortable with the structure of the primary and secondary market, with the liquidity that the authorized participant market makers bring, and also the genuine liquidity that's generated by investors trading against each other. But there's still ways to become far more efficient, and in fact a lot of the institutional world feel much more comfortable trading at the NAV of the product versus an intraday price, and I think that's where we're going to see the next move in the European market is much more reliance on efficient trading through the day rather than waiting for an end of day price. And one of the key requirements, I think, when you are trading individual products is make sure you understand the product, make sure you understand the index, make sure you understand the assets that are being tracked and how those assets behave, because ultimately an ETF or ETP is essentially just a gateway into that asset class. It's not an asset class in itself. So essentially the ETF needs to be understood by the client, to be able to get an efficient hedge. And, as Matt quite clearly mentioned, if you don't have that knowledge, then, use a broker and they will help you along with that. But what sort of questions or answers do you need to achieve before you understand the products? When does the underlying hedge open, close? Is there a concentration of volume at certain times of the day? We often have concentrations at the end of day, start of day, or when the US market's open. Are there market announcements that may affect pricing? Lots of the commodity products are affected by, announcements versus supply and demand, or economic numbers regarding, large market cap benchmarks. Do market makers or APs have inventory? So if they have inventory, they're more likely to price that much more tighter than if they have to go and create and redeem. So you may get some benefit there. And also look at the size of the order relative to the underlying market being tracked. There's a huge difference to trading something like palladium versus trading the S&P 500. And quite rightly, you would expect there to be a big difference in the size of trade you can do comfortably versus those two different assets being tracked. And also think about, would a risk price be better than a worked order? So do you want an immediate price? Have you got some sort of hedging issue? Or are you happy to take a sort of average price through the day? So there's all sorts of different requirements you can look at when you're actually trading ETPs. So the next slide, if we look at understand spreads and total costs, we sort of touched on this a little bit, but I think these two concepts can be pretty confusing for investors, and I think it's worth just looking at the basic formulas that you can look at for this. And we all, I think, spend a long time over the last 10 years talking about total expense ratio, and I think most investors assume that's the total cost of owning a product, but essentially it isn't. You've got more things to worry about and think about. So we've talked about the spread, the difference between the bid and the offer. Typically spreads reflect the following components: the price of the underlying asset you're tracking, the cost of the hedge that the market maker is using to enable them to price the product during the day, the manufacture cost of the creation or redemption, and plus the margin, the money they want to make, and within that they'll have some capacity built in for if they get their pricing wrong, because ultimately their systems are extremely electronic and fast. But there can be errors and problems, and there are people waiting there to arbitrage the market makers, so they will build in some spread there. And ultimately that gives you your best bid and offer spread that the calculation will do. When the market makers, I mentioned that these are fully automated, so if you do call up a market maker from a practical perspective, it won't take them long to give you a price, because they will have spreadsheets running with thousands of products at any one time, and they'll be able to very quickly give you a price, even if they're not the official market makers on exchange. And total cost of ownership, this is different than the spread. This is the commission you'll pay on the way in and the way out, the spread of the product, the management fee of the product, which we generally call TER, and tracking error. And tracking error usually is issuers will have some other costs involved in running the product that wouldn't be included in TER, and that would be the total cost of ownership. So that's slightly different than the spreads. So, how do you improve your execution? What practical things can you do? As we said, you've got to understand the underlying asset being tracked, trading times, liquidity, etc. This stuff's pretty much all available on Bloomberg and looking into the products. And as we mentioned, you can talk to experts like brokers as well if you need to, and they can go away and find out. You've got to understand the ETP you have interest in. There are differences. You can buy the same product from different issuers, and there could be tax differences or there could be construction differences which give you a slightly different return. So it's always important to understand that there will be differences between the two. You've got to discuss the mechanics with both the ETP issuer and market makers and APs. So feel free to call the issuers if you've got execution questions. Even if you're a retail person, feel free to call them. Most of them will be very helpful, and many of them actually run departments called capital markets, which their sole job is to ensure that there's a good experience on the execution and it's as efficient as possible. And it's fairly likely the issuers see, if you've got an issue or a problem or a question, it's fairly likely they've answered that several times, so they should be in a great position to help you maximise your potential there. and then you also have the market makers and APs to fall back on as well. And again, they've been around the block a fair few times, so if they're active in the product, they should be able to come back that. And then learn from your first trade, and not just your first trade, but the next one and so on, because you will always be able to do things better and understand things differently than when you did before you did it. So you've got all that opportunity. So the sort of trading strategies you can employ. I mean, really, these are book standard what you would do with equities generally, but sometimes people don't realise you can do them with ETFs. So I thought it was worthwhile just reinforcing that. You can use the same order types you'd use with equities, so limit orders. This basically helps you, set a limit price that you're comfortable with getting in or getting out at. And gives you a potential to control the price that you execute at if you're going to do a on-exchange order. Then you've got market orders, which really is just basically just making sure that if you're happy with the price, you can execute it there and then. As I mentioned before, the retail market tends to be done on a RFQ basis and increasingly on the institutional basis as well. So you do get a bit of time before you execute. In the retail space, it's up to 15 seconds. So you do get a chance to have a look at that price and make sure you're happy with it at that point. Larger sizes. One point of caution in Europe, which is very different than the US, if a market maker in Europe gets hit repeatedly on the order book, because that is a faceless process, they don't know who is on the other side of those trades. They'll tend to assume that they're being arbitraged, so they tend to widen their prices for a period of time to just check their pricing models to make sure that they're in good shape, and then bring their prices back, their spreads back in. So if you've got a larger order and you see that happening, you're probably better to use the OTC option and call a market maker up and execute it that way. And in that way, the market maker knows who you are, the type of client you are, and the fact that you're not arbitraging them, so you'll get a better price that way. The OTC market, risk prices, market makers can give you a fixed price against their hedge. So essentially, if you're trading the FTSE 100 and you want an intraday price, they'll go and look at the futures market and, through their pricing sheets, give you an instant price at that point. Probably charge you zero commissions because their margin will be built into that price. One very popular way for people to execute is worked orders. So you give them an order and instructions to, work it over an hour or over the day or at the close. So basically they will average out that trade basically to the requirements of the client and how the client feels it's the most risk-free to do the trade. A lot of people like the liquidity at the close of the auction. Most of the volume in products is around this time of day because most people have end-of-day pricing to look after. So investors can tap the deepest liquidity at this point. Again, a word of caution here. If you have exotic products with different underlyings, then you need to be very careful on this, that not to confuse the closing of the local market versus the closing of the markets of the underlying asset being tracked. So, for example, if you've got an emerging market basket, you have to be careful that the close of London is not that relevant for the liquidity of that product. And RFQs, if a broker institution wants an audit trail for best execution, the RFQ platforms are becoming obvious choice and are growing dramatically. And as I say, MB here, trading times, opening times of underlying announcements, macro news, etc., take all that into account. The last thing you want to be doing is buying something just before a major announcement, and the price may move, 3, 4, 5% over that very short time period. So just the next graphic here is just a representation of the broad investor set that you can get for various ETFs, and this holds sway for any ETF. There's a whole range of institutional clients, retail, private bankers, wealth managers, institutional managers, hedge funds. It is a very democratic product. It charges the same prices for everybody, whether you buy one share or a million shares. So you have the whole gambit of investors there to choose from. So the whole thing is one size fits all, and that is obviously the great power of the ETF. That essentially it's a single product for the whole market. You've got lots of different strategies you can employ with ETFs. A lot of people will use them for many different things. One of the key uses is cash equitization and cash flow management. So if you've got a slug of money coming from investors and you don't want to invest it straight away, you might be investing into small caps or medium cap stocks. So you may want to park the money in the ETF to take the market risk out of the trade, and then work into the individual stocks if you're a fund manager, and then exit the ETF over time. You may want to hedge. You may have circumstances where you have a FTSE 100 portfolio and you want to hedge the market moves in that you don't want to exit the individual securities you've got, so you use the ETF to hedge that trade. You may want a futures or swaps alternative. You may like the fact that ETFs are generally very, very strong on counterparty risk management and well constructed, and you may feel less au fait with the derivatives market, so you have an alternative to that. You can do hedge fund type strategies such as pair trades, long short trades. You can use this. You can either use a short ETF, or you could even short an ETF through the borrowing market. That's a much bigger market in the US than it is in Europe, but certainly is increasing in popularity here. They're very liquid trading tools. I mean, most exchanges you look at, the most liquid securities tend to include ETFs on a daily basis now. So you'll tend to find that some of the most liquid stocks in the world now are ETFs. You've got some classic examples in the US like the Spiders and Qs and the GLD, which are enormous products in terms of trading volumes in AUM. So they become like, and we're getting the equivalent of those in Europe, such as Euro stocks, the FTSE, some gold products, etc. So you've got lots of similarities there. And then, you can even get simple cost-effective leveraged market exposure as well if you want that, either through leveraged trading, such as CFD, spread bets, or through a leveraged ETF. So you've got those choices as well. So they're very, very across the board good fits. And then classically, you've got both tactical and strategic asset allocation as well. So if you want to build a very cheap portfolio asset allocation-wise, you can pull that together very easily with ETFs, whether that's at the retail end with the SIPs and ISAs, all the way up to multi-asset funds who will generally use ETFs quite actively in order to express those products and those ideas. So I thought I'd give you some specialist short and leverage trading strategies. One of the interesting things about short and leverage ETPs is that they give you both the ability to leverage your positions and also short or hedge the market that you're interested in. And obviously that's quite advantageous, particularly in more volatile markets. Some examples of trading strategy you can employ here. You can use short-term in low return environments. So, up until the last couple of years, we've seen a very flat equity market, whereas returns have been 2-3% rises on an annual basis, but the daily movement in the market can be up to 1%. So you may want to leverage that daily or short-term environment in order to make some alpha in the markets. You can use a leverage product to effectively gain the same delta, but use less money, and then essentially use that capital difference to go and invest in something else. So you could, for example, want to put £100 to work in the FTSE 100. You could use a 3 times leverage product, use £33 of that, and then use the other £67 to go and invest in a bond and create a yield or something like that. So you have those opportunities. You can hedge positions in one simple trade. So essentially, if you're a UK small and mid cap fund manager, and the market starts to fall, you don't want to exit your positions, because essentially the market's going one way and you'll get run over. So you could use a short FTSE 250 ETPs in order to hedge yourself there, in order to prevent you having to close out your positions. You can use long-short strategies or pairs trades. So, for example, if you wanted to buy gold, go long gold relative to silver, you could use a long leverage gold products against a short silver in order to represent those sorts of trades. I mean, they're quite complex. But one thing you do really avoid with these products is you don't need complex stock borrowing arrangements or financing in place or complex documents. You know, you can really just use a product that trades very similar to an equity. You can tactically use it in a portfolio to increase or reduce short-term market exposure. You may not have a long-term view of you know, the US bond market, but you may think there's going to be a short-term rally. So you can use products to gain that exposure in the short term and then alter that position over time. And essentially you can have a whole raft of strategies in order to create extra returns in your portfolio as you go along. So basically, in wrap up, in terms of ETP trading, I think the strong message is try to understand as much as you can about the product before you trade it. Talk to as many people who know about the product as you can, such as the issuer or the APs market makers, in order to understand them better. And before you execute it, don't learn by error. But if you do make an error, then use that information and essentially you know, get the experiences you can through your trading of your portfolio. And over time, you know, get very used to how the dynamics of the ETF work, and then as such, you should gain a very good experience and take advantage of the very low fee entry and exit and carry costs that ETFs provide. On that note, I'd like to hand back to Matt and Rebecca and thank them for their time today.
Thank you, Hector. I thought that was great. Rebecca, I think you were going to lead the Q&A. I know we've gotten some questions from the audience. If there are other questions that people want to ask, remember you can enter them in using the Q&A tab at the bottom of your screen. Rebecca? Hector, are you still there?
Yes, I'm still here.
All right, great. Well, maybe you and I can continue while Rebecca figures out her audio difficulties.
Sure.
You know, I was going to ask a question about risk-based trading versus working orders. Certainly, you know, there's a big question about the best approach to making a big trade in the market. Maybe you can talk about the sort of costs involved in each and the risks involved in each, and how a large investor might weigh the choice between getting a risk quote and asking a liquidity provider to work the order over a period of time.
I think the question really relates to, you know, what you're trying to achieve from the trade. You know, if it's very important to you, you get market exposure very quickly, you know, it might be a hedge or you may want to close out a position, then obviously a risk trade makes sense. But the pricing that the AP or market maker will give you will reflect that risk. So essentially, not only will you you know, you'll be having the costs we've talked about built into the manufacturer or destruction of those ETFs. You'll also you know, you will also carry the risk element that the market maker is building into the price as well. And obviously, the larger that trade is relative to the underlying asset, the higher that margin will be. Whereas if you're, you know, if you're more of a sort of asset allocator and you're strategically taking a position using an ETF, you know, using a worked order will make sure you average out your costings. So essentially, you know, you'll dip into the market when there's liquidity, and essentially you should be paying the lowest margins at that point as you go along, both from a hedging and a cost perspective. So essentially, that's the difference in impact between the two. But again, that exercise on the averaging could cost more if it's quite a small trade that you want to do, because ultimately you will be doing a number of different transactions as you go on.
Right.
And one of the other major differences, obviously, the risk trade will probably be OTC, whereas the sort of averaging will probably be on exchange.
Right, absolutely. No, great answer. And this one's from the audience, but I do think it's probably a common question out there. What happens if you're a financial advisor buying on a platform where you're not always in control of when you trade and what you get? What sort of guidance would you have for someone in that situation?
Well, that's where I think that you've got the power limit orders, and I would suggest that the instructions you give to your advisor are very clear. I think it's extremely important that you don't just give them carte blanche to do anything. So my guess would be that the best way to approach that would be to provide limits to the broker or the platform provider, to sort of tell them that the pricing you're happy to get in and or out at, and in that way you can control the order much easier.
Hector, thanks for that. I'm hoping you can hear me now.
Yep, loud and clear.
Sorry about that, my audio issues. I have got a couple of questions from the audience. The first one is, what is the difference between the NAV and the INAV, or the INAV, however you want to say it?
Okay, yep. Well, the NAV is the official price that the fund will create or redeem at, and typically it's the end of day price. The most transparent price that is in the market. So typically, for commodity futures-backed products, it will be the settlement price in the market. For equity markets, it's usually the close, those sorts of things. The INAV is exactly what it says. It's an indicative NAV through the day that is calculated based on the components, as they dynamically change. It's not an executable price because it's a price that's typically produced by exchanges or data vendors, but it just gives investors comfort that the official market making price or the price discovery that's on the exchange is where it should be. And obviously, if there's a major difference between the INAV and the official price on the exchange, then it's usually typically pointing to something being wrong. And an investor should ask that question before they execute if they see there's a major difference between the two.
And are they calculated the same way? I know that the NAV is calculated by dividing the value of the stocks by the number of existing shares in the fund. Is that how it's calculated with the INAV?
Yeah, I mean, I think the INAV is produced as closely as it can be to how the fund is constructed. But ultimately, the way the market maker will calculate their pricing will be way more accurate. I mean, if you get the INAV wrong, you don't lose money or make money. But from a market making perspective, the prices you make are the prices you live and die by. So essentially, one will be much tighter than the other. So for instance, with an INAV, typically you can get errors such as dividends or whatever, and the actual provider of the data that goes into it may have got something wrong that the market maker spotted, but the INAV provider may not have. So, you will get differences.
Okay. The next question I've got talks about authorized participants, and they ask, when you're trading an ETF, should the investor be aware of how many authorized participants a provider works with? And does this ensure that the investor will always have enough liquidity?
I think, like we alluded to earlier in the presentations, I think all three of us touched on this, that there is quite a lot of competition because there are multiple market makers and authorized participants. So I think that a healthy competition is always good for investors. So I think if you've got a product that's got simply one or two authorized participants or market makers, then probably your preference would be for a product that would have way more than that. Simply because you want the surety that when you get in to the product, you can get out on the same terms, and the more people you can go and get a price off, the better. So, for instance, the RFQ facility that a lot of institutional guys are using now, they'll typically send that order to as many market makers and APs as they can, and I think they'd be pretty uncomfortable if they could only send it to a couple of guys.
Mm-hmm, mm-hmm. And how would you go about assessing the quality of an authorized participant?
Well, I mean, one thing that people can be relatively sure of is that the issuers, don't want to be signing up every single financial institution that would come along and and want to be an authorised participant. So there will be certain standards because ultimately there will be, the trade, the sort of creation and redemption orders that are put in will be relatively large size. So in order for the fund company to take risk against those organisations, i.e. trade with them, they will want them to be of sufficient stature to be able to do those trades efficiently and obviously from a credit point of view in a credit-worthy fashion. So you tend to find that the maximum number of APs or market makers that are involved in products will be circa 10 to 20. It certainly won't be 100. So those 10 to 20 you tend to be global stature financial institutions, usually investment banks and specialist market makers. So I think from that perspective, most investors should be fairly happy.
That's brilliant. I know that I touched on commissions briefly when I was doing my presentation, but there's a good question here that asks, what commissions should I be aware of when trading directly, and do brokers take a big chunk?
Is this from a retail perspective or an institutional perspective?
I think probably from a retail perspective.
Yeah, I mean, from a retail perspective, generally the commission they pay to their broker will be the only commissions involved, and the RSPs who those brokers execute against will tend to be just making money from the bid offer that they put in the market. So they won't charge anything on top of that per se. So the price they pay within the bid offer should be what the cost will be, along with the commission that they pay the broker. And as you quite rightly mentioned, that sort of ranges from 5 to 12, 13, 15 pounds type stuff. So that should be about right.
I think we've got just enough time for a couple more questions. And one of them sort of talks about cross listings across Europe. I mean, and how does this affect trading?
Well, the argument is that it splits liquidity because ultimately you've got multiple venues across Europe where the same product is listed and traded. So, for instance, if you have 100,000 shares traded in London and the same product is listed on the Borsa Italiana as another 100,000 there, then you've split that liquidity between the two. I think in all reality, though, we have to realise that Europe still has many languages and many different nationalities and many different tax structures and different laws, etc. So even though we do have a lot of cross-border activity, the local exchanges still do provide a shop window for these products to be understood and known and traded. So I think that for now, even though we are seeing efficiencies and consolidation both in the listings and the settlement regimes, I think that there is still a very important feature of shop window into a local market provided by the relevant listings.
So would that sort of direct investors towards using their home domestic exchange?
Yeah, I think it does, and I think everything combines for that, right? That say we had one exchange, in Europe, and that was in London. Will an Italian journalist or a German journalist cover that product as well as he would do if it was listed in their home markets? I don't think they would. So I think you get the whole ecosystem that gets built around a listing. Not just the actual listing itself, but all the PR, all the awareness, or local language information, all that sort of thing that becomes relevant. Plus, as well, there are different tax regimes, and I think, for true harmonisation in Europe, from a listings perspective, we would need a lot of progress in terms of harmonisation on tax, and we all know that means harmonisation. Would mean significant harmonisation in terms of politics across Europe, and I think we're still not even a country mile, a continental mile away from that happening, to be honest.
True. I think we've got one last question very quickly. Should retail investors be encouraged to buy and hold in volatile markets?
I think it all depends on what people are doing as their investment strategy. I think, one of the bubble slides that I showed before, there's lots of different reasons that people trade and hold ETFs generally. And I think that if a retail investor is building a simple portfolio that they're looking to manage and control for a significant period of time, then entry points are less important than if they're going to trade actively. So if they're going to trade actively, then they may want to be more tactical and therefore want to trade the volatility. So I think it all depends on what the retail investor is doing. I mean, one of the great things now in the market that's there that wasn't there when I first got involved in ETFs is there's a wealth of material, be it from the trade magazines such as Money Week or Investors Chronicle or whatever. There's specialist websites like yourselves. Yeah, and there's even general stuff in the money sections on the weekends that there's plenty of information out there about ETFs. So I think that like I said before, I think people should definitely read up and try to understand as much as they can about the general product itself, but also about the individual products they're looking at. And as I mentioned before, the issuers are very, very helpful in this respect, and any retail client should feel quite comfortable about calling up an issuer and asking questions, and most of the time they should get reasonable answers.
Brilliant. Hector, thanks so much. I think that concludes our webinar on ETF trading, tactical solutions for any market. Just to let you all know, the webinar will be available on our website in the next 24 hours. And I'd also like to invite you to join us again in 2 weeks' time for our webinar on understanding your exposure, a look inside investment vehicles. Thank you very much for listening. I'm Rebecca Hampson, European